Welcome to our detailed exploration of the shadow banking system. My name is Your Name, and in today's video, we'll unravel the complexities of the shadow banking sector, illuminate its integral role in modern finance, and examine the risks it entails. Shadow banking refers to financial intermediaries involved in facilitating the creation of credit across the global financial system, but whose members are not subject to regulatory oversight. These entities include, but are not limited to, investment banks, mortgage brokers, and money market funds. Unlike traditional banks, they are not governed by the same set of regulations, making them prone to different types of risks, including liquidity risk and market risk. To get a clearer understanding, imagine the traditional banking system as a neatly regulated canal where banks adhere to strict rules of engagement. In contrast, shadow banking operates more like a river flowing outside the canal, free, fast, and less regulated. Let's explore the size and significance of the shadow banking system. As of 2020, the Financial Stability Board estimated the global shadow banking assets to be around $63 trillion. That's equivalent to around 150% of the GDP of all high-income countries combined. Now, you might wonder, how does shadow banking benefit the economy? Well, shadow banks provide credit to borrowers who might be deemed too risky by traditional banks. This fosters financial inclusion, encouraging economic growth and liquidity. Let's take a closer look at a real-world example. Mortgage-backed securities, MBS. These are created by pooling together home loans and selling the collective debt as bonds to investors. During the 2008 financial crisis, MBS played a crucial role. For example, imagine a bank has 100 home loans, each worth $200,000. Instead of holding these risky loans, the bank packages them into a mortgage-backed security worth $20 million and sells it to investors. This transfers the risk from the bank to the investors. Now let's delve into some questions and answers to solidify our understanding of shadow banking. Question 1. How does the shadow banking system contribute to financial instability? Answer. Shadow banking can contribute to financial instability due to its lack of regulation and oversight. The 2008 financial crisis was exacerbated by the collapse of large segments of the shadow banking system, particularly those tied to subprime mortgage lending. For instance, the AIG liquidity crisis during 2008 highlighted how the lack of adequate buffers in the shadow banking sector resulted in systemic risk. It required a federal bailout to prevent a complete collapse. Question 2. What measures have been put in place to mitigate risks associated with shadow banking? Answer. Several measures have been implemented post-2008 crisis, including enhanced regulatory frameworks and increased oversight by financial authorities. The Dodd-Frank Act in the U.S. is a prime example, aiming to increase transparency and reduce risks in the shadow banking sector. Next, let's discuss some key statistics that highlight the growth and impact of the shadow banking system over time. Now, can shadow banking be entirely replaced by the traditional banking system? Probably not. Shadow banking plays a critical role in credit creation and risk management in areas outside the purview of traditional banks. Finally, let's recapitulate what we have learned today. Shadow banking involves unregulated financial intermediation outside traditional banking, plays an essential role in credit delivery, and involves significant risks and rewards. Thank you for joining us on this deep dive into the shadow banking system. If you have any questions or topics you would like us to cover in the future, please leave them in the comments section below. Don't forget to like, share, and subscribe to our channel. Until next time, stay financially savvy.